Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.
Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the very first time, a huge welcome to our community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. We are speaking with Jared Pohl. He is the co-founder, partner, and a portfolio manager at ECP Asset Management, an Australian fund manager really focused on growth companies. And that's exciting because we all love finding a growth stock, a company that's growing quickly, you know, taking market share, expanding into new markets, whatever it is. And today we're going to really unpack Jared's process to finding those companies and then managing a portfolio full of them.
So we unpack a lot of the metrics that Jared and the team use in their investment process, and there's a bit of jargon throughout this, but one particular metric that he often refers to is IRR. Now, if you've just joined us for the very first time, IRR is an acronym for Internal Rate of Return. Simply put, it is how much money Jared and the team expect to make from that investment.
So before we get into it, a massive thank you to ECP Asset Management for sponsoring this episode and helping us keep all of our content free here at Equity Mates. If you want to find out more about ECP, we'll include a link in the YouTube description and show notes. So thank you to ECP. But Bryce, without any further ado, let's get to our conversation with Jared Pohl.
Jared, welcome to Equity Mates.
Thanks, guys. Good to be here again.
So we want to start with the ECP Investor Toolkit because, you guys continue to grow and we imagine the team is growing alongside that. And we want to use that framing to unpack your investing philosophy and the skills that you're trying to build. So when a new team member joins ECP investment team, how are you articulating the ECP investment philosophy to them?
The way that we run our business is that the process is very well structured, so people can come in and then work within those frameworks, and there's like guardrails that they'll bump into, and those guardrails are effectively the other members of the team who will say, hold on, we're going to push back here, or we're looking for this. But we do have very specific things that we're researching. So in our case, companies in the growth phase of their life cycle, that means something very specific. You know, companies that are growing revenue or they're expanding their economic footprint. There are some assertions that we are trying to prove up as well, like characteristics of businesses that are in this phase or more likely to be in that phase. So, big markets we're looking for, or companies that understand their internal drivers of competitive advantage. And we've documented what that looks like. A lot of people will be familiar with, Barney or Porter's analysis, for example, which is like an external competitive environment toolkit to say, if you've got supply power or consumer power or et cetera. We use that, but also internal drivers of competitive advantage. So what resources are available to the firm, for example, that drive that competitive advantage? And that might be reputational. It might be, a mining tenement like lowest cost of extraction or highest grade, for example, or it might be a technology edge like NVIDIA or TSMC. So if those companies understand that internal driver, they'll invest behind it. And a really simple example of that was A2 Milk back in the day. They owned the brand A2, which was that protein, and they invested behind that. No one else had that. It was all like A1 free or et cetera. And that really helped them develop that competitive positioning. And so all of these different characteristics we're looking for are written down and they are tested internally. But there's that information transfer in the team. So anyone can come in, like let's just say they've got the goods, they can come in and then they'll learn what we're doing. But we wouldn't necessarily pick someone who's got a real value bent, for example, or hasn't got any passion for investment. And all we're trying to do is just sort of refine the edges a little bit and say, look, we want people to be naturally expressive of their ideas, but they've got to be looking in the right area.
So to bring that philosophy and some of those guardrails to life, what does a great stock look like at ECP?
Yeah, they express themselves quite differently, but essentially what we're looking for, if my ultimate company is one that has a big market to operate in, that you can invest behind and it can have like a decades of growth. And that might be not in just one vertical, but they can expand. They've got lots of options available to them. Let's talk about a really old example, REA, realestate.com.au. Like everyone will be familiar with that. At the previous firm that I worked at, we invested in that business. I think there was like $2.70 was when we invested in the company. This was early 2000s. And at that time, the thesis was essentially that there was this very big classified ads business that was offline and it was shifting online. And you were seeing it happen everywhere around the world in all sorts of marketplace verticals. Everyone thought we were crazy for paying, I think we paid like 25 times earnings for it. The market was on like 17.
God,
and everyone was like, you guys are like nuts, everyone thought we were we would just buy things that were expensive. But for us on a 10-year view, this thing was super cheap because every eyeball, 80% of those eyeballs were coming from online, but only 20% of revenue was online effectively. And so you could just see the shift happening. Now that was very specific ads. But as you can see with REA, there's been all of these other verticals that they've expanded into, and that's that optionality that I'm talking about. It's not just the advertising piece. So we were looking for that. So that's the first thing you want is big markets and lots of optionality. Then we come back to those things we were talking about before, like internal drivers of competitive advantage. What does that mean? And for them, there was this big network effect. And now that's a common phrase, but effectively the more people that went there, the more people that would advertise there. And so that flywheel started to move and there was economies at scale. So increasing economies to scale. And that's another thing for me that we really want to look for. But there's that expresses in different business models in different ways. So like Megaport's a true network effect. The more nodes on that network, the deeper the network effect. REA, like these marketplaces, you sort of dominate because people go there because everyone's there and they advertise, So there's different business models that do different things. But broadly speaking, that's what we're looking for. With respect to growth, again, it's not necessarily just revenue growth or profit growth. You do want businesses that are expanding. And it can be not profitable at the beginning, but effectively that a business that's growing above its markets, it's above system. So, if the market that it's operating is a 10% growth and they're doing 15 or 20, they're taking share or they're doing something different. And so that's another rule of thumb that we tend to focus on. And then profitable growth is a really big thing for us. We want companies that are not growing through financial engineering or through leverage or acquisition, but more organically growing. So they're spending $1 and getting $2 back or something like that.
And so when you're training up a team member to start, putting all of this into practice, what are some of the hard skills that you're training first? Is it like the evaluation model? Is it just like understanding balance sheet?
Yeah.
Like what are you trying to focus on?
When we're hiring, we actually spend a lot more time on the person, not the skills that they have. The assumption is that people can do the job. But much more important to me is culture. Who is the person in the seat and are they the right fit? Now, we don't have anyone that's come from a bulge bracket or everyone's come from a very unique path. One of the most recent additions to the team's got like a philosophy background. But everyone has a demonstrated passion for markets. And that is more important to me than can you read a balance sheet? Because you can learn that. So we spend a lot more time on that and spending time with them and really getting to know them as a person. What do you think about when you're investing? Talk me through your investment portfolio. Why did you do that? Because it's super important for us that they can fit into our framework and they're not going to have this fundamental internal philosophy that's quite different. We have had that before. We had a guy who joined our team who's not with us anymore and he's gone on to be very successful in his own right because he's doing what suits him. But internal with us, there was a clash, because he just didn't have that same growth mindset and was putting ideas in and then we would shoot them down, not because there was an issue with his analysis or anything. It's just not what we do. And it was very tricky for us to put it in that portfolio. So we spend a lot more time on the people first. But generally, people that have been wrestling with investment in their minds really understand balance sheets, how they work, and the things to think about. Now, I still learn every day from members in the team. Like, things will be said, and you just go, "Oh yeah, that clicked for me," and the same for them. So you really want people who are going to push you, but in a junior type of level, if we're going to say that, I think really you want someone who's got like a real grounding in modeling. You don't want to sit there and train them and tell them, this is how you can adjust the cash flow statement or whatever. We don't have time for that. But I think the biggest thing for us is just being open and working through our process and really trying to understand why we do what we're doing, not just saying, I can do a DCF. I mean, valuation's a solved game. Yeah. That anyone, you give them a model, they can plug in their forecast, they can get a reasonable valuation. what the real art of investment is understanding this stuff and seeing the asymmetries and how they play out. And that stuff comes with experience, unfortunately, but it's not like, can I model, yes, I'm going to be a good investor.
It's interesting you say that, like valuation is a solved game. And I think particularly like in the sense of like using the information that's available today, everyone can value and we'll all get pretty close to each other. The challenge is valuing an uncertain future.
Yes.
And I guess that's just like reps on the board. That's a process thing. That's a seeing, 100 companies and the 101st one starts to make a bit more sense. How do you, I guess, like train some of those like soft skills and insights in a team and like,
I don't think you can train it.
Yeah. So it's just reps, just a lot of mistakes.
Honestly, I'll talk about me because it's something that you have to click for yourself. And I'd mentioned it, my father founded Hyperion and he had a very strong presence around what investment was. And I had to fight against that quite significantly because I had my own opinion. Fundamentally, I still believe in growth investing, obviously, because we do that at ECP. But I really had to work hard to own it for myself. And what I see is different to Sam or Damon, but we have to work together as a team to see those asymmetries and how they play out. It's not something you can tell someone. It's like battle scars almost. For our style of investment, you've really got to have some faith in the future. And you've got to really think about how that can coalesce in the future, how the structure of the markets will change. And you're taking a bet which is not proven, and it's very hard to put probabilities on that. So in a sense, it's not rational. In a sense, there's this faith that's required to let things happen, but it's got to be grounded in some reality of what's possible. And it really takes clear thinking, and you'll see whether it's Munger, all of these people around that talk about it, everyone's talking about getting clear thought and clear thinking, because you've really got to put yourself in a future state and see what the shapes can be. And then are you convicted enough to risk capital against that relative to other people? It's not something you can just tell someone to do. It's something that they actually have to do, and they've got to learn it. And that's been my advice to any junior, aspiring investor. It's always been risk your money and think about how it doesn't matter what it is. You could just go and buy CBA today. Put down the reasons that you own it. Does that play out? Yes or no? And then you've got to be self-reflective enough to say, I got it wrong or I got it right. And did I get it wrong for the right reasons or right for the wrong reasons? And really go through that process of journaling or understanding. If you don't do that, you're not going to be a good investor. I guess it's the same as being, an elite athlete or anything. You've got to really kind of play with that and really get lost in the sort of process. And then over time, things start to make more and more sense to you, and you've seen enough things, your heuristics get better. But ultimately, it is a faith thing that you're going to get it right, but it's grounded in research in our sense. We try and narrow the outcomes, and that skill is something that you develop more and more.
Yeah.
So how do you, as an investor, but also as like a leader of the team, how do you deal with periods of uncertainty when sort of stocks...
Like right now?
Yes. Maybe sort of really going against you.
Yeah. Well, we've been talking about it a lot because, we don't try to apologize for what we're doing because we've been applying our process very diligently and clearly, but we do make mistakes. But there's just been things where we've got things wrong, and I can bucket them into two camps. One is a position sizing issue and the other one was a thesis issue. So how do we deal with it as a team? Honest communication is a big one, and then that self-reflection that we've been talking about. But you really have to sit down and say, what decisions did we make? Why? And we document all of this. So we've got the evidence there to say that we have been thinking about these things for a long time. And in the one case, Domino's was the one that we really got wrong, and it's really hurt us a lot. Now, in hindsight, we should have exited that when we invested in Guzman because we didn't need an exposure to two QSR businesses. That being said, there was a lot that was going right for Domino's at the time. Japan was a bit of a tough market for them, but other things were doing well. Aussie was actually, even though it was mature, it was still growing, and Germany was doing all right. But the Japanese situation definitely outperformed during COVID, and then they've tried to get it right. So you could give management the benefit of the doubt. We'd been there for a long time. Anyway, there's been a lot of management turnover and so forth. And then you were left with, well, that thesis was degrading. Maybe it was, maybe it wasn't. I don't know if we would have made a decision. If I went back in time, would I have still made the same decision? Probably. And as a team, we probably still would have made the same decision. But the outcome of this discussion we'll get to in a second about how to try to manage that better. That thesis was degrading. And it took us a while to say, right, we're forced out. And then, recent CEO departure, we're like, look, it's just, there's not even a question here. It's gone. And it was announced that day we're out. Unfortunately at like $15 or something was probably the low of the share price. But, for us, it's that thesis is officially broken. We're gone. So the big question in that issue was like that thesis was degrading somewhat. And, what was happening effectively at Domino's is that the unit economics per store were declining. And that impacts the health of the franchise. So where we're at now and what we're trying to be a bit more explicit about with respect to how we determine a thesis and then how we manage those theses, because we've been pretty good at that. But this has shown the sort of creaks in the armor, so you've got to be able to articulate the core assumptions of that thesis. And effectively a key driver of that, a core assumption of the health of that network growing is the unit economics per store. That's been degrading. So that's a leading indicator that thesis is weakening. And so we should have, when we started to see that, said, right, it's time to move on, if we didn't have confidence that they could turn it around. And this is the tricky thing with the thesis, is that you always got to give people the benefit of the doubt other than, or because you might be jumping at shadows. Not everything happens in a straight line. There's not this linear growth. It's up and down and back and forth and tensions. And, the irony is that we've made a lot of money from things that have had short-term headwinds and then have come right because management have just been subject to something they can't control and it's put pressure on the business, but they've kept executing and then they've, come out in a better way. So there's not an answer that's 100% correct here, but we've just got to still say what broke down for us and how do we manage that better? And being more clear about those assumptions that drive that thesis is where we've landed. And so we're starting to track that more clearly. That sort of flows onto that position sizing issue. So another one which we still own is IDP education. And that's another one that's really impacted us. And if you think through the thesis, it's a market share growth story. That's pretty clear. We still think that that's happening. There are some challenges around the one of the pillars of those assumptions for me. Students are really important, like international students are really important to fund the university sector. Students really want to travel overseas to study and governments will be supportive of that. And at the moment, that's the one that's really probably the weakest of the three. And what that's led to is a funnel, the collapsing of that funnel. We don't think that that's going to change, but we're watching that more closely. I think they're under their caps in Canada and, we'll see what happens in the UK. But ultimately that business is still, there's nothing wrong with the business. It's just that sort of supply side or, what the governments are allowing is it's just shutting that supply side down. The demand is there for all of the things. So position sizing there has been a challenge. That is not new news. It's something that's been happening for a while. But the challenge with our process, and I think, it's it's the bug and the feature of what we do, is that we're anchoring on such a long-term time horizon that we see the value in this thing that others are not looking at. They're all looking at a 1 year forward, this thing's going south. And they're right. In the short term, it probably is going down. But we've been stepping in and acquiring a bigger position in that company, but it's been affecting our performance because it's under pressure in the short run. Yeah. And unfortunately for us, we have a long-term view, so we're anchoring to that. Is the thesis broken? No. Is it under pressure? Yes. Are we feeling the pain? Absolutely. But what do? Do you just not follow your process and see the value and go for it? Because there is an asymmetry here. I mean, it's so cheap today compared to what it's ever been. The business is bigger than it's ever been. And if things turn around, it's going to gap up very, very quickly.
Yeah.
But that's not guaranteed, like the world might be changing enough that all of a sudden there's a structural shift down in the number of students or whatever, but then they've just got to take much more share to offset that. So, if you put it into those two buckets, they're kind of related, but so that one we were oversized, and that's a big issue, and we think about how to manage that in a go forward as well. But there's definitely been others, like Block yesterday started to rally, and we've had a big position in Block, and that's been underloved. I think it was up 10 or 11% yesterday, which is great. I mean, we needed to go up another 10 or 20 some performance, But again, it's the thesis is intact. It's been under pressure. GQG was the same. People didn't like that, and it performed really well. It was a massive position. Then we withdrew. So you've got to take the good with the bad, and sometimes it's going to go against you, and sometimes it's going to work for you. And on average, we've outperformed more than we've underperformed.
Yeah, I was going to say you're sounding very hard on yourself. I did have a look at the Aussie fund. Since inception, you still outperform your benchmark. So
Yes.
don't be too hard on yourself.
Yeah, like I said, it's a bit of a therapy session today. We're just getting it out.
Yeah. When you've got those like longer term, like IDP as an example, you've got that longer term conviction that it's a good business, it's well run, and there's an opportunity there. But obviously, short term headwinds. Do you have a trading strategy around that, or is that not something you guys really get into?
This is one of the hardest things, timing. There are some very, very good people at that game, but they're playing a very short-term game. And the problem is you can only optimize for one thing, really. You can't be short-term and long-term. You're either this or that. The nature of the way that we manage money, in that we allocate capital to the highest returning ideas, means we're short momentum. And that's a really tough thing to be short in a market. Like the fact that we outperform and we're short momentum is a really strong signal. We get termed contrarian growth by some of our more sophisticated clients, which is interesting because we tend to sell winners. We're hopefully not selling them too early, but we reallocate to those things that are underperforming. So the challenge for us is to try and change the shape of that, to let the winners run longer and then maybe not buy as quickly. And so all we can really think about is what's driving the change in share price. Is it earnings revisions or is it mood of the market? And if we have a fundamental view that the market's wrong, like a Hub, for example, or Net Wealth, when everyone was hating the company because they had, the cash spreads were low, like this is not going to happen forever. I mean, the reality is that the big driver of value for these companies was a market share growth story, and it's structurally growing. And like Hub's got over 100 billion now in AUM, and it's awesome. Like they were doing 20% of net new flows with like 2% market share at the beginning when we invested to them, and now they're continuing to do this march along. But it's such a structural market that who cares about the cash spread over a year? Rates will be cyclical, and then they're going to earn like they have been. So in that case, if we got all sensitive about it and then exited the position, we would have missed out on a lot of alpha generation. And this has been a really big contributor to the portfolio over a long time.
Yeah.
Jared, we wanted to dig into the growth side of things a little bit more. Obviously, earlier you explained that your focus is on the growth phase of the life cycle. So what are some of the key metrics that you look at for a growth company? But also like what's your hurdle or the line between that's not a growth rate we're interested in, this is the growth rate we're interested in?
The absolute number's not really a determinant. So we've got companies like Samsara, which are growing 40% year on year still and have been sustaining that for a very long time. And we've got more mature companies that are growing maybe revenues at 7 to 10%.
Okay.
It's more about how they are relative to their opportunity set, and is this company topping out in its market? Like can it grow any more within its market? And there is some change in the rate of change of growth. Earlier on will be much higher and then it'll slow down, but that's okay. We don't need very spicy growth companies in the portfolio that are just 100% super growth, because the forecast error on those is just so big. But you also don't want things that are now hitting maturity, and we still own them, like Car Sales, REA and Seek. These companies are approaching the maturity curve. How much more margin can Car Sales take in the domestic car market? Like, I've had a view for a long time, and, Cam, he did a great job as CEO and he's stepping down. But I've always argued with him about this, where I've said, well, look, I don't think you can take much more. Maybe you're going to get CPI inflation adjusted kind of growth in your core business. And you can see, like, implicitly they agree with me because they've gone and bought Webmotors and they've gone, they've done all these other things in other markets to get the growth at the group level. So, that's approaching maturity. But Webmotors has got a lot of runway still. Like, that is very early doors. It's a replica of Australia. They're putting in lead generation fees. They're just doing everything, and they've got this huge market to grow into. The US, I'm not as excited about, but, they can do some things to optimize there. But, that's hitting maturity. It's not necessarily time to exit, but it's approaching that. It's not 7, 8, 9% positions in the fund anymore. It's, 2, 3. And at some point it'll be 1 and then it'll be gone, like CBA. We used to own that, and, Damn. Well, it's funny. We used to get told, like, why do you own it? You're a growth manager. And this was at I think it was 11 times PE at the time. And now it's like, why don't you own it? And you're like, well, it's 30 times. Like, it's expensive. It's a bank and the earnings haven't done anything in the last 5 years. So, you can't win them all.
No. So I imagine it's a balance of like quantitative factors, revenue growth rate, margin expansion, but then also a number of qualitative factors, which
Yes.
are probably harder to define. But what are some of the things that you're looking for on a qualitative side?
Yeah, so we have 18 assertions, and they're generally more characteristics of a company. I mean, the obvious ones is like, where are they in their penetration? Like that's a really big thing for a growth company. Like, can you, have you got 20% more growth, or 50, can you double your business? So it always starts at the market level. Then what we're looking for is really like execution and understanding, as I spoke about a bit earlier, like competitive advantage and how that's going to scale. A lot of the metrics that you might want me to give you is sort of an output to what we're looking for. So if companies are executing well, if they're attacking the markets in the right way or creating value for their end customers, they're going to scale very quickly. Wise in our global portfolio is a really good example of that. It's like that Costco model where you just keep reinvesting your profit into the customer, and it helps to really expand that footprint. And that's like $1 trillion market, like the FX market. So they've got a huge runway to go, and they can just keep investing and investing and investing, and they'll keep growing. So that's more relevant to me, is the market size and their opportunity to capture a portion of that. Then they're growing revenue at 15%, because some months it might be 15, others it might be 1. That's the output of what they're doing. The return on equity that they're generating, or the return on invested capital, is all a function of the decisions management are making. And so it is inherently backward looking. So we would rather focus on those core characteristics that exist. Do they understand their competitive advantage? Do they have pricing power? Are they competing on price or value? Like all of those underlying things to get to where we think they can get to. All of that gets put together in a bucket to say, is this a high quality franchise, and is there growth potential here? And is it in that growth phase? Like, is it scaling? Are they investing more costs in the business, not taking costs out? And so it is very much qualitative, more so than quantitative. But those quantitative metrics are important to validate that things are tracking in the right way.
Yeah.
So we're more use them as a measure to say, okay, our thesis is playing out. And if we see the thesis playing out in the right way, it will lead to these quantitative metrics like sales growth, ROE, margin expansion, etc.
How do you differentiate companies that have like sustainable growth versus just short-term momentum?
So like RL, will come back to that again. Their ability to extract value has been quite significant, but the irony is that they started out offering a better product for much cheaper. The cost of a print ad was very expensive relative to an online ad for a long time. And I think now it's still like $4,000, roughly on average for an ad at REA. That's still cheaper than what you used to pay for like a big spread in, the local magazines. So their ability to sustain that has been because of the dominance of their position, their ability to pull price, the elasticity of demand, all of those things you really got to think about. And where companies do offer that, they can pull that price lever in a way that's, there really isn't another option. So that tends to lead to companies that can extract more value and continue to do that. And people generally just assume this fade in growth. Like if you look at any consensus type model, it's like 10%, 8, 6, 5, 2, But you actually need to think about where they can get to at a terminal value. What does that look like, and what's the path to that? And a lot of it is the qualitative thinking. And so when I talk about valuation being a solved game, a lot of people spend their time on their models. We do as well. We've got a very focused universe, so we have the time to spend thinking about modeling. But the most time we spend is about the actual process of investment, competitive structuring, all of this stuff, like the really non-tangible things, because that feeds into your ability to think about terminal valuations, terminal asymmetries. How does the shape look? And you might not be exactly right, but you'll know kind of directionally where things will be going.
Well, let's turn to selling, and this might be part of the therapy session after some of the conversations we had earlier around, a slow degradation of a thesis with Domino's. But I guess what are your sell signals? What are you guys looking for that a company sort of moved out of its growth phase? And I guess, from recent history, what are some additional learnings in that space?
So there's a couple of ways that we would exit a position. The first is, and the most clean, is a thesis break. So a very clean example in recent history was Serco. I don't know if you know.
No.
Yeah. Okay. So they're like a travel software company, and effectively they did in the corporate space. So they provided software and corporate booking engine. They did a JV with Booking.com. And the market loved that. It was because they were sharing in the benefits of Booking.com. It was a really big funnel, more customers, etc. That was our core thesis, was that they were getting an outsized benefit from this relationship. Booking.com renegotiated the terms, where effectively they were just basically being paid as being a service provider, and the upside was capped to them and immediately gone. So that thesis was there, and then it was not. So it was out.
Yeah.
So that's quite clean. In the grey areas, like we were talking about earlier, is that a thesis degrades, and you kind of, what we should be doing in that instance is the position sizing stuff. We should be adjusting our forecast down. Dominoes, we should be, revenue per store coming down, store rollouts coming down. So our internal rates of return that we generate should be lower, and that should manage position sizing, which leads me then to the next part of how we sell. So as our IRRs decline, we start to trim the position. So in an ideal world, the share price goes up and it does really well, and we should be out. We should have a 40% IRR and then a 0 IRR, and then the position was 10% and then it was nothing, and then we've captured all of that value, and then when it comes back, we'll re-enter the position. So selling is very much driven by our expected return and or a thesis, so it's either or. As companies get more mature, the forecast should be reflective of that, and so the weight range in the portfolio might be, like I said, 1 to 2%, or instead of 2 to 4 or 4 to 10. The earlier stage companies tend to have higher expected returns and then higher weights in the portfolio. So we're doing the complete opposite to the benchmark, and we're anchoring on expected return value, not size.
Yeah.
And that's a little bit counterintuitive for people, particularly how they think about risk and stuff like that, but makes us more risky, quote unquote. But I think the asymmetries that exist, or the systematic risks that exist in the benchmark, are much bigger.
Yeah, it's funny. It's like you say it's counterintuitive, but it's counterintuitive for people who are like institutional finance professionals who measure risk as volatility and stuff like that. But if you actually like go back to first principles, which is like, I have a pot of money and I'm trying to maximize the returns with that pot of money, it is intuitive. Yeah.
Yes, that's right.
The ones that I think have the most growth potential are the ones that I want to own the most of.
That's right.
Yeah.
But finance theory says otherwise.
Yeah.
And it's elegant in its own sense. I'm not going to argue with kind of mean variance optimization or anything like that. It just doesn't work in a concentrated growth portfolio or any concentrated portfolio. You just can't short half of your 10 best names. Yeah.
How concentrated is your portfolio? Like, how do you think about, you've sort of just said how you think about structuring it, but like how concentrated is it?
Yeah. So this is a little bit technical, and the guys are going to laugh at me because I do tend down this path. But there's a fundamental law of active management, Greenwald's law of active management, and it says either that you have a high degree of skill and you can only apply that to a narrow breadth, or you've got a low degree of skill and you can apply that to a large breadth. So what I mean by skill, it's like, how predictive is your signal? So in our case, it's our IRR. And our IRRs are very predictive of return. And so we should apply that to the things that we have the most confidence in. It sort of makes sense, right? Like, we don't want to be anchoring on like our 100th best idea with a very low IRR. We want to coalesce around maybe the top 20 things that we think. And even within that, there's probably like 10 positions that are actually meaningfully contributing at a time. And there's others that are lower. So skill, like, doesn't scale is one of the key ideas there. So, quant funds are capturing very small incremental bits of information, and then they're adding that up to build a 1% tracking error, maybe 1.5% alpha. And a lot of traditional fund managers in active management land used to do that as well. I don't see the point. I think you should just index it, or, take an enhanced passive type approach. But then on our side, you've got to have skill that's repeatable, but then you need concentration around that. And this is a very difficult problem. How do you build diversification in a concentrated portfolio in a way that, you're subject to bigger drawdowns? So, if we have a 10% position that's off 50%, that's a material impact to our alpha. It could wipe out your alpha for a year or more. So thinking about how to manage those is a very difficult problem. But the general idea is that if you have no future information, you should just equal weight the portfolio. And I think we covered this last time, like venture capital tend to do the same thing. It'd be like $1 million per
bang, bang, bang.
per opportunity. And they're really diversifying the book without any future view on.
Yeah.
And then you say, okay, well, if block, which is our biggest position, because we've got we have a very high confidence at the expected return, the market's mispricing that, we should have more than an equal weight in that. So, it's up to 7-8% in the portfolio. And then equally, there'll be something where we've got a lower return that sort of the capital needs to be taken from there and given to there. So this competition for capital idea is a really important thing. And then it's about how much you want to risk that at a time. But, to make good return, you do need to have the conviction to risk. And people sort of ask you, oh, what's your competitive advantage? But I think conviction is an advantage in markets. And you can't outsource that to ChatGPT. You can't outsource that to an analyst. You've actually got to do the work yourself and really own it internally to have the conviction that you can see that there's that shape differential. Yeah. It doesn't always pay off, right? But when it does, it works well, and that's where you get the benefit.
So let's talk about managing downside risk, because that's inherent in a growth portfolio. And you said it earlier, like, if you've got a 10% position and it falls 50%, I was having a look at your fund report earlier. You've got Block as one of your largest positions, just shy of 10% in the report. Not sure what it is now. But, it was only, 3 years ago that Block fell 80%. Yeah. So how do you think about managing downside risk with some of these high growth names?
The biggest input to that in our process is the forecasting. So what do we think Block is going to deliver over the next 10 years in terms of earnings and cash flow, et cetera? Because we use that to build our expected return. And then we map that expected return relative to other things. So, Block might have a 30% IRR and Megaport might be 10. That's actually a good example to talk to because it shows how we dynamically change. So I think 6 months ago, or a bit more maybe, Megaport was at like $6. And we were a substantial shareholder in that business. It's now like $14 today. I haven't checked the price recently, but it's roughly in that range. And we don't have a big position at all. And Michael, it's not that we don't like the company. We really like Megaport. We've been a shareholder for a very long time. But this has happened repeatedly. If you go back and look at the chart, you will see it was like 4 and then 18 and then back to 6 and 12. And it just does this thing. And there's been no new information in the market at all from the company. But there's all this anecdotal information around, they're selling all these new products. Yeah, we know about these new products. There's like $200 million of revenue that they need to shift and really scale. And I think Michael can do it. I really do. But it's not going to happen in one result. So when we start to see the evidence of that, we will change our forecasts accordingly. And then it might be that they do at this result and we get the evidence that it's actually coming through. And then we'll update our forecasts. And then we don't need to buy anymore because the share price has gone up. Our forecast is holding it at the right position. And so if we get our forecast wrong, we're going to incorrectly allocate capital. So that is like the worst thing for me is that we over allocate to an under earner because we've got big positions in a company where we've actually got this thing wrong we're taking unintended bets then, where if we're very good at getting our forecast right, which we should, as we know companies better and better, we should forecast better, then we can position size in a better way. And Block at that point, we didn't own a lot of it at the time when it drew down, but when it drew down, we started to increase our position. The last couple of results where there was a few slip-ups there from a market perspective, yeah, we got hurt a little bit, but, there was no fundamental thesis break and we kept allocating or increasing to the position and it's now starting to turn. Hopefully that continues on its march and then we'll reduce our position size and capture the value that we've been seeking.
Yeah.
So position sizing is a tricky one to get right, but for us it's more around forecasting is the big thing.
Yeah.
Nice. Well, Jared, to close out, like growth stocks can, kind of you just illustrated, can get ahead of themselves sometimes in terms of valuation. How do you manage that moment where you sort of you own a stock, you believe in the future, but then you kind of say, I wouldn't buy it at this price, but you've still got sort of a 10-year horizon?
Yeah, so Pro Medicus is one we don't own.
Yeah, good example, yeah.
We've never owned it. We have exposure to an unlisted company, which I think is a competitor or will change the nature of the market. Yeah, in that position itself, the forecast that we have, we just don't see much margin expansion coming through. So the IRR is not going to be driven through earnings expansion like Hub, for example. We've got very, very high expectations for revenue growth, but you really have to capitalize like effectively then winning majority of the market, like in a very long time horizon. And we go a long way to that. But I think we've still got a negative 12% IRR.
Yeah, wow.
But it doesn't mean we're going to be right. Like the share price is probably going to continue because they're going to keep announcing contract wins and they're going to keep, they're an amazing company. We really, really think that this is a very high quality company. But from a valuation perspective and downside risk perspective, like this thing could very easy halve. If there's a slip in growth rates or something happens, like that thing can just halve immediately. Yeah. And that to us is that the asymmetries are just too big. Even though we love everything about it qualitatively, I don't think there's a company that we've got more admiration for in the portfolio, but the valuation there we just can't get over it. In the case of something like Nuix, where I was talking about that a lot for a long time, it was at like 60 cents. at $7.30, I think it got to, there was no way we were going to own a position in that company. And it had nothing to do with the quality of the management or the opportunity. It was just the market got ahead of itself, and the valuation was just capitalizing very high net revenue retention numbers, and they had never delivered those. So, people were giving the company a lot more credit than was deserved. And again, if Jonathan's listening, I don't dislike the company, mate. I really do. But, as investors, we've got an opportunity. We have to be rational.
Yeah.
And you have to say, okay, what is being priced in? Am I willing to take this risk? If I am, great. But there will be a time to buy it, and it's now back with a 2 handle, and we own it again. They'll come to the result. We'll see how it goes. But I nothing has changed in my numbers at all. Same with Megaport. Nothing had changed in my numbers since the last result. But all of a sudden, people want to pay another $10 for it per share.
Let them. You'll sell it to them.
I hope I'm right.
Well, just to illustrate how much growth investing has changed over your career, you said earlier that you guys were getting criticised for buying REA at 25 times earnings.
Yeah.
Pro Medicus is currently trading at 344 times last year's earnings. Growth investing has changed. But look, Jared, we do appreciate you coming in and unpacking your process, and I think there was a lot of really great insights for people who are trying to get on top of this growth investing thing themselves and manage their own portfolios. So
thanks for the opportunity to speak. And if anyone ever wants to reach out, we're always available to chat to people. If they do have burning questions on growth investing, they know where to find me. I'm pretty visible, I think. So
we'll include a link in the show notes to the ECP website.
Great. Thanks very much.
Thanks, Jared.
Good to see you again.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.